fourth quarter of 2021 already. I'm Kevin French and I'm going to be looking back at September 2021, telling you what we saw in the markets around the world at that point in time, and also having a look forward and giving you Core Wealth's perspective on some of the things we are seeing at the moment. Similarly to August, in September the two big global news items came out of the two biggest economies. In the US, their jobs numbers came out lower than expected. But if we look at the year as a whole so far, they've created good jobs, many jobs, and they have also seen wages increasing steadily through the year as the demand for labor has increased. We've also seen inflation ticking up in the US, and that has prompted 9 out of the 18 members of the US Federal Reserve to say that they expect interest rates to rise in 2022. If we look at the other side of the world, at China, the second biggest economy in the world, there was a big shake-up in that economy when one of their biggest property developers, a company called Evergrande, was unable to pay some of its debt. It is one of the most indebted companies in the world and has over $300 billion in debt. There was concern that this could have a knock-on effect to other companies in China, to banks around the world. And on the back of that, we saw money flooding into the US dollar as a safe haven currency, which saw the dollar strengthen during the month of September. In South Africa, the big news in financial markets this month was that it had been the fourth quarter in a row that our economic growth had surprised on the upside. This is good news, and for 2021, the expectations are that we could see economic growth above 5%, maybe even as high as 5.5%, even with the looting that happened in July. This is good in the sense of helping make up as quickly as possible for the impact of Corona in 2020. If we have a look at Corona at the moment, the good news in September was that we clearly got through the third wave, and we are now, at the time of recording, we've actually come all the way down to level 1 in terms of lockdowns, and we're seeing a lot of emphasis happening to try and open up the economy while containing the virus. And one of the developments just at the time of recording, I went just before we started this recording, the government has come out with their website and the facility to actually get your recorded proof of your vaccine onto your mobile device. So that is a good thing to see happening, because it will help open up the economy, help South Africans travel more where they want to travel, help foreigners travel here, which will be good for the entertainment and the tourism industries in particular, which are big employers in South Africa. So in September, most markets were actually down. The one area that was up during the month was the US dollar, as there was greater demand for the dollar as investors got fearful, as I mentioned earlier in the video. The knock-on effect of the stronger dollar was that we saw equity markets getting nervous, and we saw both developed world and emerging market equities, which includes the JSE in South Africa, down all over 3% for the month. One of the big drivers of the weaker returns in South Africa on the JSE was that resource prices dropped off as a fear of lower economic growth in China started raising its head, and our equity market has a lot of resource companies in it in South Africa. However, if we looked a bit deeper into the South African market, we saw some very strong returns from some of the mid-cap companies, not just your big companies, but some of the mid-cap and smaller cap companies actually were up quite strongly. So I'll talk later on about how this impacted positively on our overall portfolios. If we have a look a little bit longer term and just look at the last year, we'll see that the growth areas in our portfolios, those markets have done well. Listed property up over 50% in the last year, and then all the equity markets, South African and the developed markets in particular, up very strongly and outperforming inflation, which you can see is around 4.4% at the moment, outperforming that very nicely. If we look at at the 3 and the 5 year numbers, we're starting to see the South African equity numbers improve, and then the 10-year numbers, you're starting to see real returns or returns on the equity markets in South Africa at levels where you'd expect them to be more normally over the long term, and giving you real returns above inflation of 6 or 7%. In the month of September, we saw some good outperformance generated in our portfolios versus our peer groups. And this was predominantly from managers that we'd selected where they had exposure to the medium and smaller size companies on the JSE. One of the managers who did particularly well in that regard was PSG. This table that we're showing you now will show you our different models, their return over the last month, the last year, and since their inception, and then in brackets whether they've outperformed or underperformed their peer groups. The good news is that even though markets were virtually all negative in the month of September, our portfolios were all positive. We generated good outperformance of our peer groups, and then that you can see over the last year that picture is consistent, and we've seen some good outperformance coming through over the last 12 months. And then since inception, we've generated outperformance of our peers across all of our portfolios except our most conservative recurring income strategy, which is only 0.1% behind its peer groups. If we have a look at the international now, and this slide shows you our international portfolios, and these returns are in US dollars, we can see that the month of September wasn't a good one for us. Those returns were negative, and that was because global markets were all negative, particularly the equity markets. But also we underperformed our peers in the month of September because we have a slight overweight to emerging markets, which were definitely not the place to have been with the whole China situation happening. But again, if we look at the 1 year and the since inception numbers, and the since inception numbers will be 5 years at the end of next month, we can see some good absolute returns in dollars and then some good outperformance versus peer groups. So a big question at the moment is, has the coronavirus permanently impaired the global economy? This next slide just shows you different countries around the world, which incidentally make up 83% of global production, and looking at what they are expected to have grown by at the end of 2022, end of next year. And you can see on the far left that China is expected to be 17% bigger than it was pre-COVID. In the developed world, for example, you can see the US there is going to be about 8% bigger than it was pre-COVID. There are countries, South Africa being one of them, that is still expected to be marginally behind where it was pre-COVID, about 1.3% in the case of South Africa. So the question then is, are we expecting this to have a seriously bad impact or good impact on equity markets? And we'll talk a little bit about that. But let's have a look into the China situation in a bit more detail. So the data in that previous graph was done in July 2021. Subsequent to that, we've seen two main things happening. One, the Chinese Communist Party becoming a lot stricter on regulations with regards to education and tech and gaming businesses. Those shares came off sharply on the Chinese stock market. The Evergrande saga in September saw property companies on the Chinese stock market come off sharply, and also raised concerns around whether China will still get the economic growth that was expected in those July numbers. The reason for that being that property and construction make up a quarter of Chinese economic activity. However, does that mean you don't want Chinese exposure in your portfolio? At this stage, we continue to have exposure to the Chinese emerging market, particularly the equity markets. And the reason for that is that it's a huge economy. It's growing strongly despite these kind of challenges in the short term. And as this graph shows now, that it's actually cheap. So when the lines on this graph turn, or the blocks on this graph turn green, it means it's cheaper than its longer term history. And that's what we're seeing now, and therefore would continue to keep our exposure to China in our portfolios. So if we have a look at the South African economy being 1.3% smaller at the end of next year compared to what it was prior to COVID, does that mean we should invest in South African shares or shares listed on the JSE? First question, does economic growth drive share prices? And we've done a regression analysis, and you can have a look in the report as to what that looks like. But in essence, the results show you that share prices are not driven by economic growth per se. The two main drivers of share prices going up or down are the growth in profits or earnings and the valuation, how expensive or cheap a share is. So if we have a look at earnings growth, this is a graph just showing you whether earnings have increased on companies on the JSE or decreased, and we can see that they have increased over 100% over the last year looking back. The second question is around valuations, and you can see it, this table coming up now will show you valuations currently and what the longer term average is. The first couple are earnings yield, so how much earnings are these companies generated, and you want that number to be higher. And again, we can see actually the current earnings yields are way higher than what the longer term averages are, so the companies are generating some really good profits. And then the second one is, what are they expensive? And here you want the current situation to be lower than the long-term average, which is the case, for example, if you have a look at the price earnings ratio there. So the South African stock market is ticking those boxes of generating good profits, and at the same time the shares at the moment are actually not that expensive compared to their history. And that's one of the reasons why we're seeing or we have good expectations for the South African stock market shares. That concludes our view of September 2021 of the markets. Hopefully the next time we are recording, we'll have made further progress in terms of getting the population closer to herd immunity with vaccines. We will have seen our economy opening up a little bit more. Go and try that government website to register if you have been vaccinated, to get your QR code. As usual, if you have any questions, please give us a call. We'd love to chat to you. But until next time, thanks for watching.
Thank you.